Hello and welcome to Livewire's Income Series for 2025. My name is Chris Conway. Today I am sitting down with Challenger IM Head of Investment Strategy, Pete Robinson. He's going to be talking to us about the public and private credit space. Pete, great to see you again. Thanks for sitting down with Livewire.
Thanks for having me, Chris.
Of course. So there's been a lot of volatility lately, Pete, especially through April. We saw some rapid spread widening. How has that influenced your positioning?
Yeah, I mean, it's almost a question of what volatility, because as we sit here today, with Trump's big, beautiful bill having just passed, equity markets are above where they were before the volatility of early April, and credit markets, they've rebounded. We had about 150 basis point round trip on credit spreads, and it was really a fleeting moment of volatility. So I would say, compared to where we were at the start of the year, credit is still a little bit wider than it was at the tights in February, but not materially so. And so our positioning really hasn't changed that much. It's been a bump in the road, and I think that's something we see on the outlook as well. More of these bumps in the road as periods of whether it's geopolitics or fiscal related news, or even news around who the next Fed chair is going to be, is going to create these bumps in the road, and maybe they're fleeting, maybe they're not. I think that's the big question for markets going forward.
Yep. Just to follow up there, if I may, when those moments happen and spreads do blow out, do you try and trade around it, or do you just say, all right, well, this is a moment in time, we'll just see what happens here?
No, we absolutely do try to trade around it. I think one of the things that we do with our strategies is we invest in public and private credit, and that public allocation allows us to have some flexibility to trade. So what we tend to try to do is we tend to extend our credit duration. So basically a way to think about it is we want to increase our beta to the markets during those periods of time, so we can sell short dated bonds and buy longer dated bonds during those periods of volatility. Because the reality is, funds that have private credit allocations typically have tighter terms around redemption, so we don't provide for money on a daily basis, and so we're better able to trade during periods of volatility and illiquidity compared to those funds that offer daily redemptions.
Pete, you just referenced Trump's big, beautiful bill, but obviously that's got to be paid for, and there's ongoing macro risks, US fiscal deterioration and potential rate instability. So how are you factoring these risks into your asset allocation decisions?
I think one of the interesting things about the US fiscal situation, and really something like this idea of US dollar hegemony, which has been the prevailing wisdom for many, many years now, with that being brought into more question, in the near term, that could actually drive something like Aussie credit spreads and Aussie markets tighter as investors look to reallocate capital back into their home markets. And because the US is such a big market, all it takes is a really marginal move for that to change. And I think, whether it's here, I was just in Japan last week talking to investors there, everyone's asking the same questions, whether it's questions around the US's role in the geopolitical landscape, who the next Fed chair is going to be, how they're going to manage this fiscal deficit, which Trump's big, beautiful bill actually, exacerbates the issue. I think, what we're going to see in the near term is potentially asset prices rally off the back of that in these local markets. Longer term, though, I think there's big questions for the markets, and particularly around the long end of the US interest rate curve. And so if that 30-year Treasury really gets up into the 6% territory, I think we're going to start to have real issues.
Pete, your recent monthly talks about seeing better relative value in private credit at the moment. Can you just unpack that for us?
One of the things that we have to remind ourselves, and particularly when you're investing the way that we do, our clients pay us to be invested, and so we can't just sit out the market when we think it's expensive. So what we're looking for is looking for things that are less expensive. And really that's the story here with private credit. Private credit has rallied, but it hasn't rallied as much as public credit. So when you think about US high yield spreads that are around 300 basis points, and we're still comfortably getting 500 basis points on similarly rated private credit. So that 2% illiquidity premium, or 2% extra interest payments per annum on private credit, we still think that's a pretty healthy return for an allocation to private credit at this point in the cycle. And what we're trying to do is really balance our portfolio. So have that private credit allocation to deliver that excess performance, but also retain flexibility in our public allocations for those bumps in the road that I mentioned earlier.
Yep. Yeah, we'll get to the breakdown between public and private, but under what conditions do you think that relative value gap will change?
So first and foremost, during periods of volatility, what we tend to see is that public markets widen and private markets, your ability to transact kind of stops. Like I tell people, it's a lot like the IPO market. You know, you're not IPOing new businesses onto the exchange when there's volatility. Activity really stops. And so, you know, you can think of that as that illiquidity premium compressing. And so that's the time when we want to be rotating into public markets. On the flip side, I think we could see that illiquidity premium compress if markets stay stable for a long period of time and we continue to get new money coming into private credit. So we could see that illiquidity premium get to around 100, 150 basis points. I don't think it goes much tighter than that, simply because most of the private credit funds, including our own, have hurdle rates that they need to achieve. And if spreads get too tight, the value proposition for being in private credit just isn't there.
Pete, with the fund holding a BBB minus average rating and targeting a 2.5 to 3% credit spread, how do you decide when to add credit risk?
Yeah, look, again, this idea for us of being invested through the market. So for us, we're in the business of taking credit risk. So really it's not a view that we're taking directionally on markets around the amount of credit risk we want to do. For us, it's about the principles of portfolio construction that we want to manage. So we'll maintain a relatively consistent level of credit risk, but we'll build in diversification, really being disciplined about position sizing, really thinking about relative value across sectors to make sure that, you know, one, we're buying the cheapest assets we can, on a relative reward for risk basis, and two, that we're building sufficient diversification into the portfolio, granular position sizes, diversifying across industries so that we're not too concentrated, because risk is really a portfolio concept. And that, you know, we can have a portfolio of really diversified BB exposures and, you know, have a better outcome than a portfolio with an average rating of single A, but it's all in the same sector.
Yeah. Pete, talk to me about navigating fair value challenges in times of spread dislocation. Fair
value is something that gets talked a lot. I used to talk about it a lot and people weren't that interested. It seems like there's a lot more interest in the idea of fair value these days with ASIC's focus on the private credit market. I think the idea of fair value really is about holding something where you think you can sell it. Mm-hmm. And that's particularly important in open-ended funds because there's money coming in and going out, and that money should go in and out at, you know, where those assets can be sold. And that principle applies to public markets as well as private markets. I think during periods of volatility, one of the, I guess, unspoken things in the market is that price discovery is challenging in both public and private markets. And so you can have situations where, you know, the valuations on portfolios are stale or they're lagged as a result of lack of transaction activity. You know, the reason why we are so active in public markets during those times of volatility is because there is more price discovery. One of the things that impedes liquidity in those less liquid parts of the market, the private markets, is the fact that people aren't holding things at fair value, so they're not willing to trade. Like if I've got something marked at par, when it really should be at 90 cents in the dollar, well, I'm not going to sell it because I don't want to realise that loss in my fund. So that really impedes liquidity and it's impeding the growth of that private lending market. So we really believe that fair value is the way to go. We're big advocates for that. I think APRA has been more explicit about communicating that as well for institutional investors, whether insurance companies or superannuation funds. And we'll see what ASIC comes out with later in the year with their view on valuation.
Yeah. Pete, the fund aims for capital stability and steady income, the cornerstones for all income investors. How do you balance that with the need to take advantage of opportunistic situations?
We prioritise our role as a fiduciary delivering a total return. So for me, it's about being opportunistic but being disciplined at the same time. So a lot of times I get asked the question like, if markets get cheaper, are you going to take more risk during those periods of times? And like I said in the earlier question, you know, we try to maintain a consistent level of risk appetite, but we will, you know, try to find the cheapest assets for the reward for risk. So, you know, our focus during those periods of dislocation really is around making sure that we buy the right assets, buy them at the right price, and, you know, maintain that stability. We're a fair value investor, so over the medium term, we think we do provide capital stability. We've got a long track record of doing that, but I don't think it's appropriate to say that there won't be any volatility along the way. You know, things will move up and down, and we can share that history with our clients so they can see, you know, as things move around, we take advantage of those opportunities, and then as the market comes back, they get that pull to par effect that's so powerful with bonds.
Yeah. Pete, let's round it out. You've been doing this for 20 plus years. Have you got any war stories for us?
I moved over to the UK. I worked for a credit opportunities fund during the global financial crisis, trading US subprime mortgages. So there are plenty of war stories to emerge from that. And one I remember distinctly and really kind of had a big influence on me through my career was buying some bonds in late 2008. I bought them in the low 20s cents in the dollar. So these were previously issued at par. They were in the low 20s, and found out that the next best bid, or the cover, so the second best bid, was at about 10 points behind where I had bid them. So I'd effectively overpaid by about 40% for these bonds. When you're in fixed income markets, if you think about where we are today, that's quite a margin to be overpaying. I remember the sinking feeling in my stomach when I found out the cover and realised what I'd done. What I didn't recognise at the time, though, was, but soon came to realise, was that was more a reflection of the conditions in the market at that period of time, the extreme levels of liquidity, the lack of depth to the market that existed. And so while if I'd gone to sell those bonds the next day, I would have had to realise that loss. And in fact, we had to revalue the bonds to reflect that loss. They very quickly became some of the best investments I made in my career because of the conditions and the time and the illiquidity at the time I made it. And so, I think that's an important lesson, important reminder for me, but certainly that was a war story that I took with me.
Pete, thanks so much for sitting down with Livewire.
Thanks for having me.
If you enjoyed that interview, make sure to give it a like, and don't forget to check out the rest of the Income Series content available on the Livewire Markets website.